So there's a fair value gap that lines up exactly with this mitigation block. Now, a mitigation block is, think of like a breaker. Most of you understand what the breaker is. It's a high, if it's bearish, a high, a low, and a higher high, and the low in between. Inside that low, when you drop down to a lower time frame, the down close candle in that low, that would be the bearish breaker. In this case, we have a high, a low, a lower high that eventually went through. That is a mitigation block. Mitigation is a failed breaker, but they operate the same way. So in other words, treat it like real support and resistance. It's not a matter of looking for where the market turned in previous data. That's unfortunately the misinformation that books and other educators, and I fell victim to that too in the beginning, looking at just where the market turned around before and thinking, okay, that's support, that's resistance. There has to be some context as to why there was a turn there. And in this instance, this high here ran through liquidity over here, came down, tried to rally once more, and was unable to get above the previous high, even through all of this. So anyone that would be long here, once we drop down below it, the concept of mitigation block is the same with a breaker. If someone on an institutional level is long, when it trades back to this level here, it allows them to mitigate that potential losing trade or drawdown, meaning that any longs here that are underwater, that means they're holding on to it while it's dropping against them. When it returns back into it, it's offer them an opportunity to mitigate. Order blocks don't mitigate. Okay, price isn't mitigating. I hear a lot of folks in the community and outside my personal community, they'll say those types of things. And mitigation, that word is thrown around a lot when it's really mislabeled. So the object is, because this market rallied here but failed to take out that high, and we have a fair value gap there, our focus is to watch this one here. Now, more specifically, if we get through this fair value gap, and I'll draw it on the chart now. You can see how we're gravitating to it now. Just like magic. Okay, so the fact that we pulled back up to this level, and it's a fair value gap, this level here to me is important because it can act as resistance. It can fail. In other words, fail to trade through it, which is what we would reasonably expect, because longs here that are underwater, they're going to want to do what? Get out of it. Not that it causes the market to go down because of selling pressure. It's allowing, the market's allowing those individuals that are using things outside of retail to get out of that long position. So what I like to do is I like to read the interpretation of each PD array, where they lay out in the chart. And because we are in a day or a morning session that has seen a large range expansion overnight in the London session, it's going to be a hard sell for people to want to be long. Now, it doesn't mean that the market can't go higher, but I want to see a lot of things in my favor that would support a run. If I were being honest with you, I'd like to see it run up and take out the 65 level, 39.65. I'd like to see that. It may not do that, but I'm watching that today because I'm very leery to trust what's gone on so far this week. And I mentioned on Twitter that this week was going to be, more difficult than most of you are prepared to navigate because you're either new or you're not used to this much manipulation. And there's a lot of that right now. Lots of it. So what I'm watching is, do we respect this fair value gap with the mitigation block, because the narrative would be this. We go up here to allow smart money to offset their longs that they had here that were unable to get off. Now, you're probably thinking, okay, if they're smart money, how did they end up in a position where they're losing? Because they're human. They're going to do what? They're going to speculate just like any of us would. And they may do something wrong. They may have a bad day. They may not be firing on all cylinders. I mean, they're not artificial intelligence. The AI is the algorithm that's delivering these price movements. It's not the buying and selling pressure. But the participation of this group of traders, they're looking for these types of things in price action to instigate some reason to be long or to get out of their position, or to get short or get out of their position. And so, while that's not a lot of movement here, as a new student, you want to start with those small little incremental milestones, looking for things that draw to why price should even reach to a specific level. Why should it react or behave a specific way? Now with this wick here, okay, you see this wick? When we trade above that, I like to use the consequent encroachment of that as well, because we can have a retracement down, and it has 92.75. And this level to me would be important. I'd want to see it. It can stab through it a little bit, but I want to see if it trades down there. I want to see the body stay above it. And we'll make this thinner. Okay, and I think we've got enough here on the 15-minute time frame. We do have another imbalance here. Look at this right here. This is for folks that are struggling with my fair value gap. Look how this candle's trade down. The next candle we trade up, and then down. The next candle we trade up, almost completely closing in to that previous candle's low, and trade down. That's efficient delivery. There's no fair value gap here. It opens here, trades up almost to that candle, and then trades down. The next candle we open, we trade up and leave what? That small little gap right there. See that? So if we do manage to get above this fair value gap with mitigation that's bearish, this would need to act as support, and then we would need to power through this one if we're bullish. This one here is just the first point of interest. I'm only interested in see initially what we're doing, because we're not rushing. We're still in the opening range. It's not even been 30 minutes since we opened. So we're only trying to get a feel for what it's likely to do, but not getting excited, because why? We had a big move overnight. Every retail trader in the world is going to be wanting to do what? Chase it. Chase it where it's been going down. So you have what? Stop loss orders that are resting right above this wick. They ran to that, to a fair value gap I've outlined with the logic as to why it should go to that one, because we have a mitigation block over here. So it's not just simply oh, this looks like a fair value gap, let me just put a rectangle on it and call it a fair value gap. No, there has to be some context as to why it would be even returning back to that level. Just because there's a gap, for instance, there's one up here. There's one right here. Very small portion of it here. Very, very little. It's the low in that candle. 33 even, and the high on that comes in at 32. So it's a quarter of a point of a gap, but it's the gap nonetheless. The fact that we are in this area down here and this one here, why would I be interested in those and not suggesting something up here? Because if you look at the run from this low that we've created for the day, from the high overnight, where is these two fair value gaps? In the lower portion. So I'm wanting to justify, if smart money tried to go long here and they're utilizing this fair value gap and mitigation block to mitigate that long position or positions, they are thinking what? If that's true, if we can't get above this, it's being tipped, the market's tipping its hand that longs shouldn't be favored. So therefore, we could potentially grind eventually down into this low again today.